right, now we're going to move into the rest of the adjusting entries. The other adjusting entries that we will look at are going to be the accruals. You will have accrued revenues and accrued expenses. When we look at accruals, what you will find is that you have to increase a balance sheet account and you will increase an income statement account when we do look at these different accrual accounts. When we look at accrued revenue, this is where we have services have been performed, but they have not been recorded yet, nor have they been paid for yet. The types of things that we will see here is if we have services that we haven't billed yet, those would be unbilled items. You would see interest revenue. You could see rent revenue that we haven't billed yet also. Those are some of the things that we see on this accrued revenue side. When we look at our regular services, we will record the entry just like if we had billed it on account. So if we are looking at an entry in which we have, let's say, we have $1,000 of services that have been performed and are unbilled. Then what we would do is we would have to make this journal entry. And so the journal entry that we would be looking at would be for accounts receivable for the $1,000, and that would be our debit. And the other side would be that service revenue account for that $1,000 as a credit. So you see it looks just like what we've done when we actually have billed things on account is what that entry would look like. The other type of accrued revenue that we will see is our interest revenue. In this one, we have to figure out how much has been earned. You will see interest revenue. It could be on different accounts that you have. It could be on your accounts receivable if you're charging interest if they haven't paid it on time. You also will see interest revenue if you have a note receivable out there where you've loaned somebody money. And so what we look at here is if you had a note that was valued at $100,000 that had a 12% interest rate and you wanted to look at 1 month of it. When we look at interest rates, we are always given the annual rate. So that is the amount that we would pay if it were for the whole entire year, is what we would look at there. And we are, again, like I said, we just want 1 month. So the formula that we would use is we would take the principal amount, we would multiply it by that annual interest amount, and then we would multiply that by the amount of time we're looking at. So the way this one would play out is our principal is $100,000, our annual interest rate is 12%, and the time that we're looking at is we're looking at 1 month out of 12 months. So it'd be 1 over 12. If you are looking at days, just so that you know what to look for, if you're looking at days, it will always be over 360. So if you're looking at 55 days on this note, it would be 55 over 360. So that's just a side note so that you know what we're looking at if you're looking at days. The actual journal entry, once you find the amount, that's what your journal entry is going to be for. So what you would have is you have interest receivable. Now, interest receivable is an asset, which is a balance sheet account, and we are trying to increase balance sheet accounts. So that would be a debit for $1,000. And then the other side of it is interest revenue. Revenue is a income statement account. We will increase revenue on the right side as a credit, and so you see that is increased with that $1,000. So our journal entry will be interest receivable will be our debit, and interest revenue will be our credit. And so that is really what we look at when we look at those revenue accounts. Now for accrued expenses, these are things that we've incurred, but we haven't paid them yet. All right, so we already have incurred that expense. It is an expense to us, but we just haven't paid it. Some of the items here are going to be interest expense, salary and wages are some of the items that you will see on this side of the items. when we look at interest expense, it was going to work the same way that interest revenue works, in that we are going to use that same formula where we have a principal times interest times time. So in this case, I'm using the same example of $100,000 note times 12% annual interest rate, and I'm multiplying that by 1/12 to get $1,000. So that's that amount. What we would have in this one is you would debit interest expense for $1,000 and you would credit interest payable for $1,000. Again, this one is the income statement account. It is an expense. We increase expenses on the left as a debit. The payable account, that's the word there, is a liability. That is on the balance sheet. We increase liabilities on the credit side. So that follows the same logic that we had, in that we have to increase an income statement account and increase a balance sheet account for our accruals. The last one that we're going to look at is the wage and salaries. So an example of this is payday is on Friday. And when the end of the month comes in the middle of the week, you're going to have days that employees have worked, but we haven't paid them for those days yet. An example of this, let's say that we have Monday and Tuesday are, in the month of, we'll say, July. And then we have August. We have the 1st, 2nd, and 3rd here. So when we have this happening, the month is going to end on the Tuesday. So if we have a 5-day work week and we pay $5,000 for this work week, what we have to do is we have to figure out how much are we paying for each day. And what we're going to do here is we would take that $5,000, we would divide that by 5, and what we would find out is we are paying $1,000 a day. Well, in the month of July, we have 2 days that people have worked, they haven't been paid for yet. So that is a total of $2,000 that we need to accrue. And the journal entry that you are going to see here is going to be that wage and salary expense, and it's going to be for that $2,000. The other account that you will see here is a wage and salary payable account for $2,000. Whenever we look at accrued expenses, your expense is always going to be your debit. You will have a liability or a payable account will be your credit account. And so that is what you're going to see when you look at these accrued expenses. And so we have now covered all of our adjusting entries. We've covered our prepaid items. We've also covered our accrual items. These are the only 4 types of things that you are going to see in this chapter. The one thing that I want you to remember is that we never, ever, when we are dealing with this chapter, we never, ever, ever use the word cash for accrual entries. That is a no-no. We do not use it. Remember, that is that ugly 4-letter word that we do not use for chapter 3 with our adjusting journal entries. So do not use cash in your adjusting journal entries. That's the one thing that I do want you to remember. Remember, you have to use a balance sheet account. So you need one account that's coming from that balance sheet, and you need one account that comes from the income statement. And the whole purpose of these accounts is to make sure that we are looking at the revenue recognition rule, and that we are recording items when they are earned, and then we also are looking at that matching. And matching deals with expense recognition, and that we are matching the expenses with the time period in which the revenue is earned. So those are just some of the things that I want you to kind of remember as far as this particular chapter is concerned.